The VN index is trading near 1,878 points, showing remarkable surface-level resilience and sitting close to local highs. But a massive portion of this upward trajectory is driven primarily by mega-cap conglomerates in the Ving Group ecosystem, single-handedly propping up the broader market. Look past those top-line index points, and a severe divergence emerges. Foreign institutional investors have net sold roughly $2 billion of Vietnamese equities since the start of the year. If the index is rising and the emerging market narrative remains intact, why is smart institutional capital aggressively abandoning the market? Local traders call this structural divergence sang va da long, a green shell hiding a red core. It is tempting to look for the cause on the busy trading floors of Ho Chi Minh City, or in the operational data of domestic corporations, but the selling pressure isn't originating locally. Vietnamese equities are caught in the gravitational pull of global financial physics, dictated entirely by the United States. This capital flight is a strict mechanical response to a stronger macroeconomic force, not a localized failure of the Vietnamese economy. To understand why money is leaving Vietnam, we have to look at the epicenter of global monetary gravity, the United States Treasury market. The yield on the 10-year U.S. Treasury note has been hovering near the 4.5% threshold. This rate acts as the baseline standard for global finance. When the U.S. government pays nearly 4.5% in dollars, every riskier asset on Earth must compete against that guaranteed return. Nominal yields only tell half the story. The more severe metric driving this capital flight is DFI 10, or U.S. 10-year real yields. Real yields subtract inflation expectations from the nominal rate. Right now, this metric has breached the 2.2% mark. A risk-free asset guaranteeing a positive 2% return in real purchasing power acts as a massive financial vacuum. It mechanically drains liquidity from riskier asset classes worldwide. Institutional managers continuously weigh the safety of these U.S. bonds against the inherent volatility and risk premium demanded for emerging market equities in places like Vietnam. Capital flows back to the U.S. because a high positive real yield is the ultimate financial magnet, forcing a strict discounting of all other global assets. Those high real yields translate directly into aggressive strength for the U.S. dollar index, or DXY. The DXY has sustained elevated levels, pushing past the 101.5 mark and maintaining its dominance against a basket of major global currencies. This dollar strength transmits across the Pacific instantly. A dominant dollar automatically exerts severe depreciation pressure on frontier and emerging market currencies. We see this specific impact on the Vietnamese dong, where the central exchange rate has been pressured steadily upward, reaching 25,197 VND per USD. Managing this exchange rate volatility forces the State Bank of Vietnam into a defensive posture, using open market operations to stabilize the currency. For a foreign institutional investor, the math is unforgiving. Any local equity gains earned in dong are quickly erased when converted back into a much more expensive US dollar. Consequently, aggressive net selling becomes a highly rational strategy to halt foreign exchange losses, regardless of how well an individual Vietnamese company is performing. Foreign selling is a calculated, defensive maneuver against currency risk, entirely disconnected from the operational reality of local businesses. When we aggregate the 10-year yield, real yields, the DXY, the USD VND exchange rate, and foreign net selling, we map out the exact mechanics of this capital flight. This macro risk dashboard scores our 5 variables on a threat scale of 1 to 5. Real yields and foreign net selling sit at maximum capacity, a 5 out of 5. Positive real yields are actively pulling capital away, resulting in continuous institutional outflows. The nominal yields, dollar strength, and the local exchange rate all register at an elevated 4 out of 5, completing this high-risk assessment. This specific combination of high-risk indicators means standard equity valuations must be aggressively discounted. The cost of capital is simply too high to justify paying a premium for future promises. In this environment, investing in companies that rely on speculative growth narratives or cheap, easy borrowing costs becomes an exceptionally dangerous proposition. We are operating in a strict capital preservation regime where the cost of global money punishes speculative growth. Measuring risk is only the first step. This 3x3 strategic matrix maps out portfolio execution against 3 potential future states of the market. Scenario 1 is continued macro stress, where U.S. yields and the DXY remain elevated, maintaining heavy pressure on the dong. The action here is strictly defensive: maintain high cash balances, eliminate margin debt, and protect purchasing power. Scenario 2 is easing stress. This occurs when the DXY peaks and inflation cools, signaling that the worst of the liquidity drain has passed. Under these conditions, investors can begin selective accumulation, scaling gradually into heavily discounted industry leaders. Scenario 3 is a complete reversal, triggered by a sharp drop in yields and foreign ETF flows linked to an emerging market upgrade. This state allows for offensive positioning, aggressively eyeing beta to a portfolio through top-tier commercial banks and securities firms. Professional capital does not guess the bottom. It waits for the macro cycle to signal safety before deploying broad liquidity. During this current high-stress phase, any equity remaining in a VIP portfolio must pass a rigorous set of financial criteria. This screening scorecard demands verifiable, robust operating cash flow and consistent cash dividend payouts. Furthermore, maintaining low corporate leverage is non-negotiable. When global refinancing costs are soaring, highly indebted balance sheets become toxic. The entities that best meet these survival traits are typically found among top-tier commercial banks and the large-cap stalwarts of the VN30. In a high-yield regime, the market refuses to pay for distant narrative promises. It only pays for hard, immediate cash flow. The 5 variables we have analyzed, U.S. yields, real rates, the DXY, exchange rates, and foreign outflows, are not isolated data points. They operate together as a single, highly efficient macroeconomic engine. The US dollar's real yield is the ultimate dictator of Vietnamese equity pricing, exerting a gravitational pull that overrides local operations. Tracking local stock index points without understanding the underlying currency and bond mechanics provides a dangerously incomplete picture of the market. True wealth is protected by reading the mechanism behind the numbers, not reacting to the daily headlines. Elite wealth management relies on structural macro analysis, ignoring market noise to focus on the unyielding physics of global capital flow.